Is this your last chance to lock in current rates for the next 10, 20, or 30 years? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So Chairman Powell has admitted he's in a difficult situation. And it's not because of President Trump this time. Rather, it's that
risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation.
And what he means is that on the one hand, employment numbers have been slowing, which would call for a rate cut. But on the other hand, inflation has been slightly accelerating again, which would call for stable rates or even a rate increase. So what's a good central governor to do, right? And potentially even more importantly, what are the bond investors in our community supposed to do now? So with that in mind, here are the 3 topics that we'll be covering in today's video. 1. Did Chairman Powell open the door for rate cuts at Jackson Hole? And is this your last chance to lock in current rates for the next 10, 20, or 30 years? 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the predicted yields for the upcoming week's treasury auctions? And in this section, we'll also talk briefly about some of the top yielding new issue agency and corporate bonds that are on offer right now, because some of our members asked about this in yesterday's live Q&A session. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Did Chairman Powell open the door for rate cuts at Jackson Hole? And is this your last chance to lock in current rates for the next 10, 20, or 30 years? As we just touched upon, and as Chairman Powell pointed out in his eagerly awaited speech at the Fed's yearly conference in Jackson Hole in the mountains of Wyoming, the U.S. economy is currently sending mixed signals. Our economy has created new jobs every month this year so far, but employment growth has been slowing down. At the same time, inflation seems to be somewhat trending towards a 3%-ish level, as you can see here. Core services have been in this range for a while housing services and core goods seem to be going in this direction as well. And while a 3% range may be a far cry from the inflation peaks that we saw post-COVID, it's still noticeably above the Fed's often confirmed inflation target of 2%. Now, when Congress gave the Fed the dual mandate to promote maximum employment and stable prices, it didn't say on which side the Fed should err if these two goals were in conflict, as they are right now. Again, the weaker employment numbers would call for cutting rates, while the stubbornly higher inflation would call for higher rates. And what a good Fed chairman does in such a situation is to keep his options open and say nothing, essentially. And that's what Powell did.
When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate.
Not that helpful, meaning that we will have to wait for the next round of inflation numbers and the next Federal Open Market Committee meeting on September 16th and 17th before we really know for sure whether they cut the rates or not. Chairman Powell did, however, drop a few hints during his speech, indicating that he was concerned about employment, but less so about the inflationary effects of the new tariffs. He now seems to think that, yes, the effects of tariffs on consumer prices are now clearly visible. But he also said that a reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. In other words, tariffs might make some goods more expensive, but once these price increases are digested, they shouldn't trigger a whole new episode of runaway inflation. And it seems that enough industry observers took these statements as a sign that Powell opens door to interest rate cut, citing labor markets. Equity markets seem to agree and were up sharply on Friday after Chairman Powell's comments. Lower rates make shares look more attractive in comparison to bonds. Plus, they may help businesses overall as well. At this point in time, I personally think that this is not an unreasonable expectation that the Fed will cut rates in September, maybe by 25 basis points first, which would bring overnight rates down to between 4 and 4.25% from the current level of between 4.25% and 4.5%. But Before you run out now and pour all your savings into long-term treasuries to lock in the current rates for the next 10, 20, or even 30 years, remember that long-term rates for bonds do not always follow Fed rate cuts, which are really for very short-term overnight lending. Rather, the rates for long-term bonds follow the market expectations for economic growth and inflation, which means that even if the Fed cuts its rate in September, the yields for the 10-year, 20-year, and 30-year treasuries could go up or down. Now, I'm not saying that you shouldn't buy long-term bonds right now if you like their yields, which are quite attractive by historical standards. By all means, go ahead and lock them in if that's the right option for you. And I'm personally tempted to do the same with a part of our bond portfolio, or maybe even buy an annuity to lock in the current levels for the long run. Just be aware that no one can predict the future, and there is a chance that we might see some even better long-term yields out there even after a rate cut. For example, if the economy continues to hum along. In fact, during many of the past rate cycles, long-term yields initially went up a bit after the Fed started cutting rates, but then came down later as the economic outlook deteriorated. As we always say, past performance is not indicative of future returns or events. Plus, it's not all or nothing here. You could also diversify and buy some long-term treasuries or annuities now with their already attractive rates while keeping a bit of dry powder in case some more opportunities will come along later. Don't forget, if you want to get up to speed fast on bond investing and take advantage of the current attractive rates before they potentially come down, then check out our summer bond course sale. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before midnight Eastern Time on Monday, September 1st. Prices will be going up this fall as we are making some significant course updates at the moment. The 10% coupon code BONDS2025 can also be used to purchase bond beginners or bond masters individually. And if you're tempted by potentially higher yields from agencies, munis, or corporates, keep in mind that a lot of them are callable at the moment. If and when rates go down, issuers may lean towards calling in long-term debt that starts looking expensive and replacing it with new issues at lower rates. So make sure you understand for how long you've really secured your attractive coupon. As I mentioned earlier, we'll be covering the top yielding new issue agencies and corporates that are currently on Fidelity's platform towards the end of this video. For now, let's move on to where treasuries ended the week. Which treasuries rose the most and which ones fell this past week. Here's our usual table with treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Basically, all yields for treasuries were down for the week, with the lone exception of the 2-month, which was up by 1 basis point. This at least seems to confirm that the bond market is starting to price in a rate cut for the next FOMC meeting in September. As it stands now, the expectation seems to be that all maturities will go down, including the long end. This is a bit different from last week, when all shorter maturities were down, but the 3-year and longer showed higher yields. This means that for the time being, the yield curve remains more or less where it was, positive, but relatively flat. And here's our usual peek at the CME Fed Watch tool. Interestingly enough, the likelihood of a rate cut in September went down a bit. It was exactly 75% at the time of this taping, compared to 86.7% last week. But I'm not sure this difference is really meaningful enough to read something into it. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The big picture versus the beginning of the year is basically unchanged versus last week. Only the extreme ends, the 1-month and the 30-year, are still showing higher yields than on January 2nd. Everything in between is down with the dip in the middle that we have gotten used to over the last few weeks and months. which means that if you're thinking about locking in the current rates, you may want to go for the very long maturities. The 20-year and the 30-year show a substantial yield advantage over the 10-year of 58 basis points and 62 basis points, respectively. These are numbers that may start adding up if you hold these bonds to maturity. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page. All sources are linked below in the first pinned comment. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we know where Treasury yields ended the week, and that it looks like the market may be anticipating lower rates as soon as September, let's move on to the next section of today's video. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. And if we scroll down, we can see that the 2-year, 5-year, and 7-year T-notes will also be auctioned off this coming week. None of these are reopening auctions, so the coupon is still to be determined on auction day. The 2-year floating rate note is also on the auction schedule, but this time as a reopening auction. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. Here's the coupon and the expected yield for the 2-year T-note auction, the 5-year T-note auction, and the 7-year T-note auction. Please keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. For those of you who've asked, the highest yielding new issue agency bond on Fidelity at the moment is from Federal Home Loan Banks, with an expected yield of 5.8%, a maturity date of September 2045, and a first call date in March 2026. The CUSIP for this one is 3130B7KP8. This second highest yielding new issue agency bond is also from Federal Home Loan Banks, with an expected yield of 5.7%, also a maturity date of September 2045, but the first call date on this one is about a year from now, in September 2026. The CUSIP for this one is 3130B7L28. And the highest yielding new issue corporate bond currently is from Dow Chemical, with an expected yield of 6.35%, a maturity date of August 2055, and a first call date in February 2026. The CUSIP for this one is 26054MJL6. This one from JP Morgan Chase with an expected yield of 5.9% may also be interesting for some of you. It also has a maturity date of August 2055, but the first call date is in February 2030 only. The CUSIP for this bond is 48130C2G9. All right, Diamond NestEgg members, Super Savers, and course fans, I hope you enjoyed today's video and learned something new. And as always, if you want to take advantage of the current attractive bond rates before they potentially come down, then check out this video here on our bond courses. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before midnight Eastern Time on Monday, September 1st. Prices will be going up this fall as we are making some significant course updates at the moment. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or Bond Masters individually. I've linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.